Hi, this is Richard Vague with Tychos. China has often been portrayed as an economic juggernaut, the chief economic threat to the U.S., and a country that will soon overtake the U.S. as the world's largest economy, if it hasn't already. China has indeed developed manufacturing prowess that helped power its rise. Witness Foxconn's iPhone manufacturing juggernaut in China, and left the U.S. looking comparatively clumsy as a manufacturer. Witness Foxconn's seemingly aborted LCD plant in Wisconsin. But after years of seeming triumph, the economic news from China is starting to sour. Earlier this month, China reported that it was continuing to see price deflation at the very time when most of the rest of the world is combating high inflation. That announcement came on the heels of reports of decelerating GDP growth and rising youth unemployment figures that were so troubling that China will now discontinue reporting those numbers. So why is China seeing price deflation, not to mention rising unemployment? It's simply a function of China's decelerating growth. If, for example, China is building fewer houses and office buildings, the price of construction materials will obviously decline. So the deeper question is, why is China's growth decelerating? The short answer is that China is running out of options for growth. The bedrock statistic for growth in any economy is population growth. And we now see that China's population is actually declining, and with its declining birth rates, that trend will only continue. For a country to sustain its population level, it needs a birth rate of 2.1 children per household, and China's has collapsed all the way down to 0.6, one of the lowest in the world. It is difficult for a country's economy to grow when its population is declining. Beyond that, stated somewhat simplistically, there are only 4 ways an economy can grow: increased government spending, increased business spending, including investment, increased household spending, and increased net exports. The first 3 of these are powered by government debt growth, business debt growth, and household debt growth, respectively. China's running out of room in all of these. And the 4th, net exports, at least the export component of it, is powered by other countries' debt growth to finance those imports, and there's little room there either. Here we see its business debt growth compared to the world's other largest countries. Its business debt levels far exceed the rest of the world, and the largest type of business debt is real estate debt, where, through massive growth in that real estate debt, China has managed to build as many as 100 million dwellings that sit empty, and the firms that built them are starting to fail. We saw Evergrande declare bankruptcy last week, and now Country Garden and many other similar companies are troubled. It's hard to stay in business when no one is buying your products. Here we can see the evidence of that ugly phenomenon in business losses, where China's businesses since 2010 have had losses on average of 10% of GDP. To be specific, that's cash losses after dividends and distributions, compared to something closer to 0 or higher for the rest of the world. By the way, that doesn't mean China, with limited alternative in its bizarre through-the-looking-glass policies, won't direct its banks to lend more here to prop up zombie companies and build yet more empty houses. And households are now deeply indebted too. The climb in China's household debt to GDP has been breathtaking in comparison to the world's other largest economies, an increase from very low levels to almost that of the U.S. in a mere 10 years. There's not much room left for higher levels of household debt. Then there's net exports. But as you can see here, the heyday of China's net exports began in 2002 when the West was having its ill-advised runaway debt boom, which allowed it massive spending on China's exports. Since peaking in that time at 8% of GDP, that trade surplus has since moderated to 4 to 5% of GDP, and increased geopolitical dissension between the U.S. and China, along with a softening or moderating global economy, will likely constrain opportunities for further net export expansion. There's certainly not sufficiently significant upside opportunity here. That leaves government debt, and in fact, China has long leaned on debt growth from local governments, often through what are known as LGFVs, or local government financing vehicles. But that has been spending on infrastructure, and increasingly China has more infrastructure than it needs and is now building roads to nowhere just to prop up the economy. And many of these local governments are in crisis since they're unable now to pay debts they have incurred to do this. So by process of elimination, we are left only with the potential spending from the central government itself. Here we see that China's government debt, central government debt, has remained at a level far below the other largest economies. So there is at least some room for growth here. So in coming years, we'll see a lot of additional central government spending to try and prop up China's job creation and growth, and it will probably be able to stave off the worst GDP trends, at least for a while. But the heyday of China's high growth era is over. By the way, one of the easiest areas for a central government to spend money in order to boost the economy is, unfortunately, in the area of military spending. So look for much more of that in the coming years. That's it for this week. Thanks.